Welcome to this custom deep dive. And, today we are asking a pretty massive question. What happens when a giant financial institution looks at that ultimate corporate rule, the idea that bigger is always better, and just, well, completely rejects it?
Yeah, it's rare to see a company actively shrink their business and somehow come out vastly more profitable on the other side.
Right, exactly. So to figure out how they did that, we're opening up this newly released 91-page SEC Form 10Q for Greenlight Capital Re Ltd.
Right, which covers the first quarter of 2026.
Yeah. And just for some quick background, they are a global specialty property and casualty reinsurer, and they're headquartered down in the Cayman Islands. But we aren't just going to, read you the numbers off a dry financial spreadsheet today.
No, definitely not.
Our mission is really to decode this filing. We want to see exactly how a world-class financial institution actively engineers profitability and navigates global chaos and manages risk in what is obviously a highly unpredictable economic landscape right now.
And there's a lot of chaos to navigate out there.
Oh, for sure. But the hook hidden in this, very dry corporate text is just incredible. In Q1 2026, Greenlight Re saw its net income jump up to $35.8 million. That's up from $29.6 million a year prior.
Which is a very solid bump.
It is. But the shocker isn't just the profit jump itself. It's the fact that they actually made more money by intentionally doing less business.
What's fascinating here is how clearly the math supports that counterintuitive approach when you really look at their combined ratio.
Okay, yeah, break that down for us.
Well, any professional managing risk knows the combined ratio is essentially the ultimate measure of an insurance company's operational health. It tells you what they're paying out versus what they're bringing in. So a year ago, in Q1 2025, Greenlight's combined ratio was sitting at 104.6%.
Which means they were losing money on their core underwriting.
Exactly. Fast forward to this new Q1 2026 filing, and that ratio has improved dramatically. It dropped down to a profitable 96.0%.
Wow. Okay, that's a huge shift.
It really is.
Yeah.
And consequently, their fully diluted book value per share rose 4.7% to $21.40.
Right.
That is a substantial operational turnaround in just 12 months.
Oh, okay, let's unpack this, because the strategy they use to achieve that turnaround goes against, almost every growth metric we usually celebrate in business.
Yeah, it really does.
If you look at their overall volume, their gross premiums written actually decreased by 8.1%, dropping down to $227.9 million.
Right.
And this drop was a deliberate choice. It was heavily driven by their open market segment, which saw an 18% drop in gross premiums. The filing specifically notes that they intentionally non-renewed certain general liability and multi-line casualty programs just to reduce their exposure.
Yeah, they just walked away from it.
Which is so interesting. I'm trying to wrap my head around this. This is like a restaurant owner cutting 20% of their most popular menu items, but somehow doubling their profit margin. Like, how does reducing your core product output actually lead to a healthier balance sheet?
Well, the restaurant analogy is fun, but it's really about the mechanics of underwriting discipline. You have to remember that in the insurance industry, it is not about volume. It is entirely about the quality of the risk.
Because every new dollar of premium is basically a legally binding promise to pay for a potential future disaster.
Precisely. A premium isn't just cash in the door, it's a liability. And right now, the filing points out that competition in the reinsurance market is intense. Everyone is fighting for market share, which is putting severe pressure on headline rates.
Ah, so if a bunch of reinsurers are fighting for the exact same contract, they start undercutting each other on price just to win the business.
Exactly. And when that happens, companies are really tempted to take on poorly priced casualty and commercial auto risks just to keep their top-line revenue growing.
Right, the whole growth at all costs mindset.
Yeah, but Greenlight refused to do that. They
Yeah.
stepped away from the bad deals. In the industry, we call this pruning the book.
Pruning the book, I like that.
Yeah, and by having the discipline to prune that bad risk, Greenlight drove their net underwriting income from a $7.8 million loss in Q1 2025 to a $6.2 million profit in Q1 2026.
Just by saying no to bad revenue, that is wild.
It's pure underwriting discipline.
But, pruning bad risk on paper is one thing, right? The real world doesn't really care about your internal discipline. You can prune your book perfectly, but an unpredictable catastrophe, what I know you guys call seat Alex losses, can just ruin your entire strategy.
Oh, absolutely. TL losses are the great equalizer.
And the filing shows this really striking contrast in how these external shocks hit them year over year. In Q1 2025, Greenlight took a massive $27 million hit specifically from the California wildfires.
Right, which was a tough quarter for the whole industry.
Yeah, but then in Q1 2026, their CTEL losses plummeted down to just $5 million.
Which is a huge relief for their balance sheet.
Definitely. But the source of that $5 million is what caught my eye. That $5 million didn't come from weather. The filing says it came from the Middle East conflict.
Yeah, that's a really critical detail.
But wait a second. I understand how a property reinsurer pays out for a wildfire in California. Houses burn down, primary insurers pay out, the reinsurer steps in. I get that. But how does a geopolitical conflict in the Middle East trigger a $5 million loss for a property and casualty reinsurer in the Cayman Islands? That feels like a massive leap from standard fire and flood insurance.
I get why you'd think that, but if we connect this to the bigger picture, it makes total sense. This is exactly how specialty reinsurance works.
Okay, walk me through it.
Well, Greenlight isn't just insuring suburban homes. They write coverage for massive global infrastructure. We are talking about aviation, marine, and energy risks.
Oh, okay. So cargo ships and commercial airlines.
Exactly. So when a regional conflict breaks out, it immediately impacts global shipping lanes, aviation routes, and energy infrastructure.
What?
You have ships rerouting, ports shutting down, and pipelines at risk.
Wow. So it turns a purely geopolitical event into a direct, measurable financial claim on an insurance policy.
Yes. It perfectly illustrates the hyper-connected nature of modern global risk. A conflict half a world away instantly hits their balance sheet because the assets they insure are literally moving through that conflict zone.
That is fascinating. And it perfectly mirrors how Greenlight actually structured its internal teams to handle all this, right? They essentially divided the house into two segments. You have the open market segment, which we talked about, and then you have the innovations segment.
Right, the veteran and the rookie, basically.
Right, exactly. The open market segment shrank, acting defensively. But then the innovation segment, which provides capacity to startup companies and managing general agents, MGAs, it grew aggressively. It went up by 73% to $47.5 million in gross premiums.
Driven very heavily by Syndicate 3456 if you look at the filing.
Right, right. But here's the catch. Innovations actually operated at a loss for the quarter. They posted a 102.3% combined ratio, and the filing blames higher than expected claims in their financial line, specifically something called transactional liability.
Yeah, that's a complex line of business.
Here's where it gets really interesting to me. It's like open market is the veteran pitcher throwing fewer highly calculated pitches, while innovations is the rookie swinging for the fences, growing fast, but, occasionally striking out. Is this divergence a sign of internal conflict, or is this a deliberate balancing act?
Oh, it's absolutely deliberate. It's a classic diversification strategy.
Okay, how so?
Well, you use the open market segment as your steady, profitable anchor. Remember, they had a great 94.8% combined ratio there.
Right.
So you use that stable profit to fund the high-growth experimental innovation segment. You need to take swings at new markets to grow long-term.
But isn't that incredibly risky if the new segment is currently bleeding money? Like, what even is transactional liability?
Basically, it's insurance for mergers and acquisitions. When one company buys another, the seller promises the financials are good, there are no secret lawsuits, things like that. Transactional liability covers the buyer if those promises turn out to be false after the deal is done.
Oh, wow. So if I buy a tech company and 6 months later, a huge hidden copyright lawsuit pops up, this insurance pays for that surprise.
Exactly. And with the economic stress over the last few years, a lot of those deals are showing cracks, which means claims are spiking. But Greenlight knows this is risky, so they are actively managing it.
Right, the retrocession thing.
Yes. The filing notes they increased their whole account retrocession program from 28.5% up to 33% for this segment.
And retrocession is basically buying your own insurance, right? You pay someone else to take some of the risk off your plate.
Exactly. They're essentially buying their own insurance to cap the downside of the rookie segment's aggressive growth. They grow top-line revenue, but limit the potential catastrophic losses.
That is just so smart. Okay, so we've got the underwriting teams fighting over risk margins. They're managing geopolitical sucky losses. They're balancing the veteran and the rookie segments. But there is an entirely different engine driving the company's wealth, right?
Oh, yes. The investment portfolio.
Yeah. The filing shows that the company made almost as much money investing as they did in total net income.
Which is pretty standard for a major insurer, but their specific strategy is very unique.
Totally. Their total investment income was $40.4 million. And an astounding $33.7 million of that came from their related party investment fund, Solasglas.
Nice, Solasglas.
And the filing notes that the fund is conservatively positioned because they believe equity markets are, quote unquote, very expensive.
Which is a bold statement to put in an official SEC filing.
It really
Yeah.
is. And instead, the fund holds active macro positions designed to benefit from persistent inflation. They specifically call out high oil prices and the U.S. administration's aggressive 2025 trade policies as the drivers of that inflation.
Yeah, they are laying out their exact worldview there.
So what does this all mean? Like, they have over $150 million in boring fixed maturities just to keep the regulators happy. But then they have this massive active fund generating huge returns by betting on inflation and trade policy volatility.
Is it normal for an insurance company to act like a macro hedge fund on the back end to protect the insurance business on the front end?
Well, normal is relative, but it is necessary right now. We have to look at the macroeconomic environment. In a world where central banks cut interest rates by 75 basis points in 2025.
Which hurts standard bond yields, obviously.
Exactly. When bonds aren't paying out, an insurer must be creative. And Greenlight is just breaking down the economic reality very neutrally here.
Right.
Aggressive trade policies, tariffs, and the geopolitical conflicts we talked about earlier, they all create supply chain bottlenecks.
And bottlenecks make things more expensive.
Yes, which drives up inflation. And here is the genius part. Greenlight is using its investment portfolio to hedge against the exact same inflationary environment that threatens to drive up its casualty and auto insurance claims. Oh, I see. Because if inflation makes auto parts and medical care more expensive, their claims payouts on the front end get way more expensive.
Right. But if their investment fund is heavily positioned to profit from that exact same inflation.
And the massive returns on the back end cancel out the higher claims costs on the front end. Wow.
Exactly. It's a closed-loop system of financial defense.
That is just brilliant. So, bringing this all together, why does this matter to you listening to this right now? Greenlight Re's Q1 2026 playbook is essentially a masterclass for anyone managing a business or even your own personal portfolio.
Absolutely.
It proves that sometimes the absolute best way to grow is to actively shrink your exposure to bad deals. And it shows that true financial defense requires pairing that kind of operational discipline with a really proactive macroeconomic view.
Yeah, and that brings up a really important thought that I'd love to leave you with today.
Yeah, go ahead.
Look, in their official filings, these are world-class risk managers, stating plainly that equity markets are very expensive, and they are financial bracing for a future of persistent structural inflation driven by trade policies and global conflict.
Right.
If the experts whose literal job is to mathematically price the future are positioning themselves this defensively, how should that change the way you evaluate your own financial and professional risks tomorrow?
That is a very good question to ponder. It really makes you rethink what true risk management looks like. Well, that wraps up our analysis of Greenlight Capital Re for today. Thanks for joining us on this deep dive.